Good morning, everybody. This is Ryan Litchfield. It's time for Coach's Corner. For my admin, my video is still turned off, and I'm not sure if there's going to be, pardon me, an introduction. Just let me know if there's anything that I need to do before I just let it rip. Robert, how you doing, buddy? As I look at the the list here, the names, I tell you what, it just makes my heart smile. It's a beautiful day here in Seattle. Jose, nice to see you. Jim, nice to see you. Helen, how are you, my dear? Robert, it has been a while. How are you, buddy? And Robert Stewart, there's Robert Keel, or I think it's Keel, and Robert Stewart. Oh goodness, this is just wonderful. A little bit of love fest here going on. Will, how you doing, buddy? All right, so let's go ahead and get going. Cole, thank you. Hey, Trip, how you doing, buddy? There is so much. Hey, Butch, oh my gosh. How are you, bud? Holy smokes. It is so good to see your name, picture your face even. Guys, there's so much that I want to cover today. I wish this was 6 hours, 8 hours, 4 hours, something, but we have 1 hour, and so let's crank. The video is able to get started, so I'll give you a wave here, and then I'm going to switch and pull up the screen and get going here. All right, so we'll do a share screen, and we're going to pop right over here. Please acknowledge, folks, that you are seeing, let's see what you're seeing. That's not the right one. That's outlined there, maybe. Let me just double check. Number 2, number 1. You should be seeing the big entry welcome screen from Wealth Builders that says Coach's Corner and my smiley face. Is that what you're seeing there? Yep. Robert Cole says, yep. All right, great. Let's get going here. This is the disclaimer that we pull up at the beginning of each one of these presentations. You guys should have it memorized by now. The bottom line is I'm not worried at all about this disclaimer because I'm not going to give you any specific advice that you could trade on per se. However, you will see some active trading going on. I will, for the record, say that this is unfunded trading, very deliberate, but it is actual trades, and everything we do is based off of actual trading scenarios. Whether they're funded or not, it's still a trade. It's still a real trade. If Apple is trading or Microsoft is trading at a certain price and we say we're going to execute a trade on here at that price, whether it's funded or not, it's still a live actual trade. All right, and I believe in doing it that way. I don't like doing hypotheticals. Back testing is absolutely legit if you do it correctly. And so with that, we'll get going here. This is just a reminder of events coming up. Please make sure these are on your calendar. Next Monday will be the next Power Hour. Coach's Corner Fridays at noon Eastern Standard Time. And the rest you're pretty familiar with, I suspect. So let's get started on this. Strangling weekly volatility. Now, guys, you know, most of you, that one of the things that I focus on is the volatility strangle connected with doing out of the money strangles. Well, I call it a balloon strangle. I've called it other things, but the bottom line is we're talking about strangles, and I'm not going to go through the balloon strangle today necessarily. I'm going to go through the elements to show you in this hour as much as I can on 1 or 2 of the elements. When you look at, and by the way, if we go back here, the point of the little cartoon, obviously frog stray. I've always liked this. I thought it was pretty funny that, how is the stork going to get the frog down if the frog's got a stranglehold on it? This finding peace in pandemonium is simply a factor of this. Okay, these are the things that I would like to be able to touch on today. We certainly will not be able to go through an exhaustive training on all of these things. but there's a few things that I really want to make sure that you have a good grasp on. So these are the things that are on the table today. We'll see what we get through depending on your interest and my interest, quite frankly. Harness high volatility options. Guys, when you are dealing with the options that we are looking at to make the strangle work, they're highly volatile because the stocks are highly volatile. So how do you choose your targeted group of stocks to work with? What strike prices are you going to use? What's the right size account? When do you open the positions? How do you capture and close out volatile positions? And then how do you take income out of them without crippling the growth of the account? These are all, every one of these could be an hour long or more discussion, easy. But I'm going to try to focus on the things that I think will be most valuable to you right now. So let's talk about this. Why strangles? And that is an awesome question. Why in the world would you want to do a strangle? If you go to Investopedia, if you go to any definition of strangles, you're going to get a technically accurate, intellectually formatted for consumption, i.e. CYA, explanation of why a strangle or what it is and why a strangle is a good idea. The bottom line is a strangle usually doesn't work. So why would you want to do strangles? Because it's a fact. Here's the deal. A strangle is a hedge. You're putting on two positions instead of one position. When you put on two positions, you give something up. You give up profit potential. The reason that they usually fail, guys, is the second point. Option pricing is extremely accurate. And it's getting more accurate as computers are more able to project behavior and analyze risk. And it is a very accurate process. It's very nearly a science, truly. There's two major components that you deal with when you're dealing with options. You're dealing with volatility and you're dealing with time. Both of those are the two major risk factors in options, right? Next, it is so powerful. I'm only going to just mention this. You can actually see support and resistance in option pricing if you know how to read it. If you look at an options chart, I could teach you how to look at an options chart and tell you where support and resistance are without looking at a chart. You just look at the option matrix. Why? Because the option risk pricing is so accurate. You can see where the best minds at managing and calculating and valuing risk, where they are putting their value of their risk. In other words, if you go to a certain strike price and they don't believe there's any chance it's going to get there, those options are going to be really inexpensive. And the volume that'll be associated with them will have a corollary. But if you go to a strike price where there's a high probability it'll get to, the options will be more expensive. Okay, that's a given. That's 101. I understand. But when you look at the matrix and you look at how it changes from strike price to strike price, you can actually see where they start hedging, where they start draining out the premium fast, where they start building it back in quickly. And you can say the belief is that it's not going to go any farther than this point. So you look at a chart and you go, oh my gosh, that's the resistance point from last week or 2 weeks ago, or that's the support level from last month. It all shows up because this stuff is very accurate. Now, market makers are seeking to go delta neutral. Why? Well, because there's too much at risk to try to guess. They don't guess. Guys, we guess, right? Jim and Susie Public, they guess. Option market makers try not to guess. They try to put this as much science as possible. And yeah, there's a little English from experience. But delta neutral means that you've got balancing positions. And anytime you have balancing positions, all you're hoping for as a professional trader is that between the two balancing positions, there's a little bit of profit. And they don't care how big it is, as long as the balancing positions guarantee that they can get that profit, they're fine. They'll sit back and say, okay, let's just run out the clock. Okay. Good traders do that. It's called hedging off risk. Now, I want you to grasp this. If you don't understand this, everybody write this down. The most profitable option that you can ever trade is a long, out of the money option. One side. If you go out of the money in the right position and you buy an inexpensive call or a put, and the stock moves in your favor, you will have the highest rate of return. You'll make the most money on a long out of the money option than you will any other position. Anything you do to try to protect against the risk will lessen the potential return if the stock moves in your favor. Now, if the stock moves against you, you've already got an option that is nothing but air. All it is time value. It will disappear. You'll lose all of it if it goes against you. That's your risk. No more than all of it. But if you put up $5 on an option, you could lose all $5. If you spend $3 on an out of the money option, you can still lose all 3 of those dollars. That's just the way it works. So, guys, it only takes one stock if you knew how to read it really well. So in other words, my ideal world would be I nail one stock down to where I know exactly what that thing is going to do just by experience on a Wednesday if it doesn't rain in Seattle. Okay? And therefore, I would take out of the money options at a particular point in the curve, in the options curve, where I would get the biggest bang for the buck. And that's the way I'd trade. Bottom line is, I'm not that good. I don't know anybody that is. Now, if I could guess really good, then that's where I'd make my money. But I don't. So you look at other ways. Doing hedging with positions like spreads and strangles and straddles and condors and butterflies and all the different things is an attempt to reduce risk. Now, why in the world would I want to do strangle if they usually fail? Well, because there is a opportunity. There is a crack. There is a weak spot in the model. And I discovered this weak spot in the model years ago with a company called Apple. And I'm going to use Apple to illustrate today, but I'm going to tell you right now, when we look at this list and it says, how do you choose your stocks? I'm not going to give you my stable of stocks. I just am not in this class, maybe in a paid class, at some other time. But I will use Apple as an example because it taught me this process. And it's a very powerful process. That is simply revolving around there's a weak spot in the option pricing model. It is really good. It is almost perfect, but there's a weak spot. And that weak spot is when you take a highly volatile stock and you put a weekly option on it and you squeeze it down into 5 or 6 trading days. You cannot properly price the options. They try. They do the best they can, but there's not enough time to allow for the volatility that could happen on a highly volatile stock. Well, then why don't they just price the options higher? They price them as high as they possibly can. If they price them too high, nobody trades. If nobody trades, there's no money being made for anybody. And if it is so volatile, it's possible that market makers could just throw their hands back and say, yeah, we're just not touching this thing. And it's possible. The options are, and it's possible as a trader that I look at it and go, the pricing is just too out of whack. I can't find the weak spot, so I'm not trading. But if you know what to look for, and I'm going to show you some of that today. If you know what to look for, you can see if there's a weak spot. If there's a weak spot, you nail it. If there isn't, you pass. It's that simple. You don't rush this. You don't force it. If it's there, you do it. If it's not, you leave it alone. All right. So here we go. I have to just touch on the last time we did Coach's Corner in January. I went into a lot of the charts on Gamma and all these things. But I just have to remind you of one thing before we dive into this. First of all, is everybody okay? Let's see. Paul White says, what is NP in the last bullet? You don't understand my abbreviation. It says, no problem. The most profitable option is long-term out of the money. So let's just do that. No problem. Just guess good. It just means you better be dead on, Paul. And it'll work perfect every time if you're the perfect guesser. All right. Yeah, you're welcome. All right, guys, so here it is. I want you to look at something. There is a reason, and we're not going to get into strategy too much of which strike prices. That's one of the major components, but I just want you to see a couple of things that are going on, because this is what frames my, excuse me, this is what frames my decision-making process. Guys, can you see what's going on? The sun is shining in Seattle, and it was cloudy this morning, and I didn't see any problem. Now, this has got to be, don't look at the little picture in the corner of me, or it'll make your eyes go buggy. gosh, what is this? You know, everybody's out in the street staring up going, what is that? All right, so here we go. These are the components that allow me to decide whether or not this is something that could be traded. If, you know, how do you pick a particular stock? What strike price? When do you get in? When do you get out? These are some of the components. So I want you to look at this. Over here on the left, the dotted line, which is this bell curve, is actually, it's a homogenized curve that shows gamma for the call and the put. So half of it's a gamma curve for calls, half of it's a gamma curve for puts. You put them together and what you find is this nice curve, which sometimes is very flat. Sometimes it could be almost a straight line. When it has a spike like this, when the gamma curve looks like this, it goes up quickly and comes down quickly. My antenna are going beep, 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 because I'm interested in that. Why? Because this gives you a high-powered window. There's going to be a high-powered movement of the options if there's any activity inside of that area. So you see the green horizontal rectangle here. That is the area that is going to have the highest volatility, the highest movement of the options. The options are going to move the fastest in that range. That's what that means. Now, if the curve was flatter, then it wouldn't matter where you are on that curve because you're going to get the same reaction. But when it's spiked up like this, you've got a hot spot. That's one of the first things. You got a hot spot. I want you to take a look. Over here on the right, you've got two columns. You've got the one in the middle, it says strike price, and then you've got gamma for the puts on the left, gamma for the calls on the right. Now remember, gamma is how fast the delta is changing. So over here to the right of that, you can see the change in delta. And then over to the far right, it says the call delta. It's just an example of call delta for 100 shares. But in the call delta, you are seeing changes according to the strike price. So go here to the blue column, it says 102. At 102, the delta is 25. Well, the stock is at 99.5. So at the money is right in between 99 and 100 right here. And that's between 45 and 56. Surprise, surprise. Delta is basically 50 at the money, right? So at the money, it's 50. Well, it's 25 down here, 3 strike prices away at 102. It is 75 at 3 strike prices away to the upside. And you can see the change in the delta at each one of the strike prices. If you move to the left, to this column right here, it says the change in delta per strike price move. So you can see that the move between 18 and 25, 25 and 34 is 9 points. Between 34 and 45 is 11. Between 45 and 56 is 11. 56 and 66, 10. 66, 75, 9. So you can see the delta, the amount that the delta changes per strike price is highest at the money. And then it starts to slow down going out of the money, and it slows down going in the money. So the point where the delta is going to jump the most is at the money. When we look at gamma, gamma is the accelerator, it's the speedometer. It's telling you how fast that delta is changing. When it goes from 9 to 11 to 10 to 9 to 8, how fast is it changing? And you can see the numbers. I want to be going the fastest possible. If I'm driving my car, I'm going to be smiling at 107 a lot more than I am at 60 or 50. That's just who I am. Some of you know that, and it's just the way it goes. I want to spend my time at 107. 100, yeah, that's good. That's okay. 107 is a little better. 100, that's still good. But when it starts, when the pedal backs off by itself and the car starts coasting, I'm going, oh, boring, right? So that's this rectangle over here. This is where you'd make the most money on those options if you are going to ride it. So if the stock moves 1, 2, 3, 4, 5 strike prices, which is 5 points, if this particular stock moves 5 points, which 5 points would you want to ride? Well, I'd want to ride it from 97 to 102 on the upside. I'd want to ride it from 102 down to 97 if it goes down. And if I want to make sure that I don't have to guess really good, I'd take both positions. I'd take the call position that would allow me to benefit from a 5-point move to the upside, and the put benefit, or the put position that would allow me to get the biggest bang for the buck in a 5-point move to the downside. Okay. Hey, Chris, I'm not sure I understand your text, but that sounds like that would be a good discussion. All right. Won't you break even? That's the whole point. That is the whole point, is when you do a strangle, most of the time they break even or you lose money. Occasionally you make money. But when you hedge, most of the time hedging doesn't work. That's the whole point. I'm agreeing with you guys. I'm not a strangle fan. I just found a weak spot. And what I was doing there was simply showing you how to find the fat part of the curve. This doesn't mean you make money. You could easily ride this and break even. But you have to find the spot. And by the way, when you have a point like this, when that gamma curve looks like this, and you take that bite out of the middle, that is where you will make money. That's where the weak spot is. If it is compressed into a short period of time and the gamma curve looks like that, if the stock moves, you will make money even with a strangle. Did that answer your question? And it's really important, guys, because the cost of the call and the cost of the put usually equal what the at the money premium is. Sometimes it's more, which makes it very difficult to make any money. The stock has got to go literally farther than anybody expected. It's got to go farther than the market makers expected. In order for you to make money, it has to outperform or go beyond what these very smart, intelligent computer models with experience have just calculated as the risk profile for the next 6 days. You lose money if it does what it normally does. You lose money if it does what they have predicted it to do. You lose money if their risk analysis is right. You only make money if it outruns what they expected it to do. So on the surface, this does not look like a winning proposition. I agree. But I want you to see how it actually works, and you decide if you want to learn more about it. It's real simple, guys. I'm not trying to talk you into anything. I honestly didn't believe this when I saw it. I had to go back and prove it and test it and prove it and test it. Okay, I honestly didn't believe it because I'm a cynic. I've been burned enough times where I suspect that there's something dastardly going on in everything. And somebody's trying to smile at me with one on one side of their mouth, and the other side they're trying to do smoke and mirrors and sleight of hand. Okay, I'm cynical that way. So I'm not trying to convince you of anything. I'm trying to educate you on some of the things I found out. You do with it what you want. Choosing the stable of stocks that you're going to work with. Guys, past is the predictor. Most recent past is weighted. If you look back over the last 6 months, that's 26 weeks. And when you're doing weekly options, that's 26 periods. I'd say that's almost too much. I'd be actually more interested in half of that, the last 13. In other words, the last quarter. What's been the behavior over the last quarter? That is the best predictor of what's going to happen next week. But I like to look back at 6 months, but I'm going to focus more on the last quarter, the last 12 weeks or so, 10 to 12 weeks, than I am even on the last 26. I really don't care what happened a year ago, except that if it was doing the same thing a year ago, that gives me more confidence that it will continue to do that. I like that, but I'm not going to make decisions today based on what it did a year ago. That makes sense to everybody? All right. So, the comment is, are we going to see an example? Yeah, we're going to see an example, but I want to make sure you've got the foundation. I'm just trying to lay this out, okay? So how do you define success? Guys, I use the terminology R. What is an R? It's one return unit, which is double your money. If you put $1,000 into a trade and you make another 1,000, so now you have 2,000, that's one R. Okay, so if I start talking about R's, come on, guys, give me a break. If I start talking about R's and things that you don't know, then you're going to go, wait, what's an R? So give me a chance to set the stage, and then we're going to blast into this, because the rest of this whole time we're going to spend together is all on one example. All right. All right. So an R is one return unit. In other words, a double. A half an R would be 50%. 2 R's is making double your money actually triple your money, right? 2 times on what you put in. So if you go from 1,000 to 3,000, that's 2 R's. Everybody good? All right, percentage of profitable weeks. You want to look at this, and if you look at the last 26 weeks, was it profitable on the trade you're going to back test on it? Was it profitable 6 out of those 26 or 20 out of the 26? It makes a difference. Okay, real-time data testing is slow. In other words, you say, well, I'm going to monitor this for the next 26 weeks. Okay, great. Then in 6 months, you'll be real smart, but it'll take you 6 months to get there. You can do it better with backtesting tools. Trade Navigator, Thinkorswim, anything with historical options data, you combine those together and you can start to get some good information. All right, now, for those of you who are not so patient, here's the example. I told you that I would use Apple as my experiment or my training tool, because this is the one that taught me the principle. So I want you to look at something here. This is looking back over the last 11 weeks of Apple. Okay, it's peaked up here at $145. It dropped down as low as 116. Now it's up at 131 today. And so what I've done is, if you'll notice, there's a little tiny box over every Friday, so I can see the weekly options from the day that you start them on one Friday and they end on the next Friday. Technically, you can do it on Thursday, but I use it Friday to Friday. Okay. And what you see here is, for example, in the first week, you can see right here on this Friday, there's the opening price. And over the course of the next 6 days, 1, 2, 3, 4, 5, 6, you get 6 trading days. The next day, it had moved $9.11. By the time you got to the next Friday, it had dropped $6. So the trading range was $6 to the downside, $9 to the upside. So what I'm going to do is I'm going to look at every week for the last 26 weeks, and I'm going to calculate what was the high-low range of movement between Friday to Friday. The next week after that, it only went $1.57 to the upside, but it went $6 to the downside. Well, not 6, but about $5.55 to the downside. Week 3, okay, $3.65. Week 4, $6.94. Week 5, $11.86. Week 6, $6.37 to the upside, $5.10 to the downside, $4.62, $6.82, $4.25, $4.01, and this last week, and actually with today, it's basically at $8 almost, but it's at $7.85 a movement this week. So what? Well, that doesn't tell me anything, except now I know what the range is, and it's pretty consistent. So I've got a little matrix up here, and I say, what's an R? Well, for Apple, an R is going to be how much money I put into the trade. If I take the position that makes sense to me on Apple, I'm going to be putting about $2,200 to $2,500 in every week. In other words, to buy the out of the money positions that I want to buy, a call and put, it's going to cost about $2. 22 to 20 if I do 10 contracts. So if I'm doing that, let's see what happens. In week 1, this says 2. What does that mean? Well, that's how many R's? Wait a minute. That means you doubled your money? No, tripled the money. What? That's true. Week 1 was a triple. Well, wait. So let me show you. Look at this little matrix down below. This is a starting point of a week for Apple. When it was at 117, we took a 119 and a 115 option position, calls and puts out of the money. Based on how much we put into the trade, the stock would have to move $3.84 to break even. It would have to move $5.96, basically $6 to double. If it went $8, it's a triple. Well, how far does it go here? It goes up $9.11. So if we're setting our stops as it passes a double and it goes up and hits a triple, we're going to be stopping that baby out. We're going to be taking it. Why? Because my goal is to make an R. My goal is to make an R. Everything above that, I'm going to cautiously move up stops and have a strategy to take that out. My goal is also not to lose more than half an R. In other words, I don't want to lose more than $1,000. In other words, lose half my position over the course of the week. And if I do that, I'm going to close. Say, oh, didn't work. Take the hit, get out. All right. Now take a look here. Second box, account size. So one of the questions we had on our list was, what size of account do you use? Well, if I'm going to trade Apple at around $2,200 to $2,500, one of the things I'm going to look at is, from a characteristic standpoint, how often does Apple not work? How often does it break even or lose money? Well, if we look at these trades right here, guys, over 11 weeks, you can see with the range of movement, this $3.65, boom, that one didn't make any money. That one lost. I know, because I've got to get to 384 to break even. But how big a loss? Well, I'm going to control it at half an hour. So you can see in week 3, I've got a minus 0.5. So we lost a half an hour in week 3. Week 2, I think there could have been money made in week 2. It looked like it, but I put a 0. If it's even close, when I back test this, I'm going to say 0. So we look at week 2, it moved $5.50 to the downside. And that's enough to make something more than half an hour, but it didn't get quite to an hour. And it did it quickly, and then it never really did anything the rest of the week. So I'm going to say, yeah, we didn't make any money. Just broke even, pulled the plug on it, got boring, pulled the plug. So if we look at 11 weeks, I've got a break even, a minus 5, a minus 1/2, a break even, a break even, a break even. So 1, 2, 3, 4. I've got 5 weeks out of 11 where we didn't make any money. 1 week where we actually lost money. Okay. Out of 11 weeks, 5 of them didn't make money. But 1, 2, 3, 4, 5, 6, 7, 8, 6 did make money. 1, 2, 3, 4, 5, 6 did make money. Week 4 was a double. Week 5 was a quadruple. What? Yeah. See this move here, this $11.86? That one pushed up, and it did it hard enough because it was at about 2 when it had this long push tail, and it just goes boom, 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 and your trail follows behind it, and there's 4 R's. Week 6, 2, week 8, 2, week 11, 2. Now what's interesting is every time there's a 0, it's usually followed by a 2. 0's 2. 0 minus 5. Well, not a perfect correlation, is it? But to evaluate the stock to see, is this maybe worth doing, you're going to simply look and see, did it travel enough to work? And if it did, great. If it didn't, next stock. So over the course of these 11 weeks, these are the R's that Apple produced or didn't. Total, right here, total R's based on the trade size of around $2,200 to $2,500, 13.5 R's. Now, take a look back here again. In order to trade something where I'm going to put about $2,200 to $2,500 in every week, I'm not going to have an account with $2,200 to $2,500 in it. It's got to be bigger. What if we hit negatives the first 3 weeks? Well, first of all, we've never had in the last 11 weeks, we've never had 3 weeks negative. We've had, or flat or negative. We've had 2 in a row. So guess what? If the behavior over the last, let's say 6 months is it doesn't do more than 2 weeks negative before it pays off again, I'm going to assume 3 negative weeks. And I'm going to say, but what happens if it goes 3 weeks in a row and it doesn't work or it loses money? How much money do I still have to have in the account to keep going so that I can play back into the strategy? In this case, I've got about $7,000 set up in order to risk $2,200 to $2,500 every week. You follow that? You've got to have enough money set aside dedicated to this strategy. And by the way, this is one piece of your puzzle. It's one oar in the water. It's not your only oar. But you've got to have some sense of how much money you have to dedicate to this in order to be able to survive what will happen. And you have to assume the worst. You assume the worst. So I've calculated negative 0.5 or half an hour, 3 weeks in a row. That means I could lose $3,000. Is there still enough left in there to go back and put in $2,500 for another 2 or 3 weeks before we catch that steam, catch that get that momentum going again? Okay. Could you do it with less? Maybe, but that's where I'd feel comfortable. Do y'all follow that one now? Somebody give me a yes. Do you follow what I'm saying on that as far as the account size? You need to calculate in worst scenario, worst case, and then have enough of a buffer to keep going if that happens. All right, I just realized the little red button means you've got a whole bunch of messages piled up, because I'm looking going, why isn't anybody saying anything? Yeah, I missed that. Sorry. Let's see. Hey, Amos. When we take this trade, are we taking the trade off at the money price, the ATM price, combined call and put? No. And you're going to see that in just a second. Amos, just hang tight. You'll see that. Tom, prepare for the worst, hope for the best. Exactly right. But you need to have the account set up so that it makes sense that you can handle a worst case scenario. All right, good. Now I'm getting all of the things I would see if I was looking at your faces. I'm getting it. Yeah, that's right. That makes sense to me. And I missed all of them here. So I'm for a while. Everybody's saying, yeah, it makes sense. Okay, good confirmation. All right, here we go. I saw everything. I don't think I missed any important comments there. All right, go to the far right here. Positive, R's, the per account, the total R's per the account size, which is 7,000, is 4.24. Chris says this only works if you buy the option going in the correct direction. No, Chris, that's the whole point. When we strangle it, we don't care what direction it goes. It just has to go. We just have to have some movement. If we have movement, we're golden. And the more volatile, the better. The whole point of this, Chris, is you do not have to guess or know which way it's going. That's the whole point. You can play with the most guys. How would you? I mean, this is akin to having a big box with a 10-foot black mamba from Africa, incredibly fast and nasty and lethal, and a spinning cobra and a fleur-de-lance, whatever. Throw them in there, and you get to go in and play with them, and they can't hurt you. You're a freaking mongoose. They can bite you, and you kind of go, yeah, what was that? All you got? That all you got? Yeah, I'll bite your neck. All right? This is a way that you can play with the dangerous stuff with relative control of the risk. It doesn't mean there's no risk. Guys, if I put the $2,500 on Apple, it could lose the whole thing. And I'm going to show you a much more dramatic example of Apple here in just a minute to prove that point. But back to this. Total R's per the trade size, i.e. $22 to $2,500, 13.5 R's. That means we made 13 times the 2,000 over 11 weeks. Based on the size of the money that we had set aside, which is the fair way to do it, you had $7,000 committed to nothing else. So your rate of return really needs to be calculated on that. For the last 11 weeks, Apple did 424%. On the most dangerous options, i.e. high volatile stock, volatile option pricing, you guess wrong, bite your neck. We did 424% on that. If we did, and there's no tweaking of this. This is just throwing it out there and letting it go with a controlled stop, i.e. a contingency stop, and just let it operate. You don't have to sit there and analyze, well, what should I do today? Should I do this? Should I do that? No. It's set it and forget it. Okay. Now, positive weeks, 8 out of 11. Average R per week, 1.23. Guys, that means 123% average per week. And we don't have to watch this during the week. You only pay attention when the bell goes off. So you set your alarms, you set it on Friday, you say, I'll check this again next Friday. Well, what about on Tuesday? I don't care. But on Wednesday, if the alarm goes up and said, you have a double, you've doubled your money, what do you want to do? Well, if you've already set your contingency, you go, don't ask me, it's already in there. The order says once you hit a double, you put in a trailing stop. Okay, great. You set that up. Ding, 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 you have a triple. Awesome. What should we do? Follow the directions. Don't ask me. This is the whole point of the contingency is to set it up. So the question is, we need a brokerage that trades options on stocks. Yeah, that question kind of scares me. Yes, if you can't trade options, you're certainly not going to be able to do this strategy. Okay, negative rows in a week, 2. That's the most. Negative per week, -5. That was the worst. So there is your setup for this. Now, let me show you the reality. You go, yeah, that's nice, Ryan. That worked for the last 11 weeks. Yeah, well, I didn't manipulate it, guys. This is what it did. You can see the movement. You can see the price into the options. Okay, let's go back a little bit in time. Here is Apple traded over a 10-week period. You see a lot of pinks here. This was not a good week, or this was not a good 10 weeks. Not a lot of volatility. The market was kind of flat. Apple was one of a stable, my stable of 7. It was just one of them. And Apple did minus 0.6, minus 0.7, minus 0.6, 3 weeks in a row. Then it did another 3 weeks in a row. It made a positive 0.3, 0.16, 0.1, and a minus 0.24 and 24. Over 10 weeks, Apple was down 260%. So that means Apple lost money. It lost $8,695. So Apple is the top line on this summary down here. It lost $8,600. Well, that's not good. No, it's not. But I mean, that can happen. So here's Apple, minus 2.6 right over here in this ranking. It ranked number 7 out of 7. Okay, it was the worst. It was the bottom of the heap. So Apple is not the golden child, except over time, it kind of is. Okay, at least it's one of them. Okay, only 3 out of 9 weeks were positive. Average, 26% a week drop. Yikes. The next stock was minus 2.34. It was almost as bad. Then the third stock cranked out over that same period of time. It was crazy. Why? Well, because you're dealing with crazy stocks. You want high volatile stocks. But you only trade them if the options are squeezed at the right time to where you go, there's an opportunity, hit it. And if it's not there, you skip it. All right. But this stock knocked it out of the park. 8.7 over that same period. 7 out of 9 weeks are positive. It averaged 94% per week. This one averaged 36% per week. This one averaged 25%. This one averaged minus 0.06. And this one averaged 10% per week. Even that, I mean, 10% per week, not so bad. The total R was 138%. So on a bad, and this was a bad 10 weeks, it was 140% gain. Total of 9.6 Rs. This is what that group, that stable of stocks looked like for that 10 weeks. Boom, punched in the nose the first week, punched in the nose the second week. Well, if you look down towards the bottom here, guys, this is that group. I took the names of the stocks up, but this is that group of stocks. And you can see at the end of the first week, there's a lot of red. Week 1, there's a lot of red. Minus 25, minus 33, minus 40. Okay. Weekly total, minus $6,000. Wow. Well, we put 32,000 in. So to trade all 7 of those positions that week, there was 32,000 that went in. By the way, if you're trading 32,000, you're going to have at least about 50,000 in reserve on this for the account. But you can take a 0 off and make the account any size you want, but I'm just showing you the portion. So the end of first week, what's our running total? Minus $6 grand, 59.89. Whoa. Week 2, maybe that'll be better. Doesn't look a lot better. In fact, it's down 9,000. Ouch. So we're down $15,000 in the first 2 weeks, but we're not out of money. That's the whole point. We can still put 30,840 into week 3, or into the next week. We actually put 31,950 into week 3. And now it starts to green up a little bit. We get a little volatility in the market and we bring 12,000 in. Okay, so our deficit is now 2,800. The next week, week 4, a lot more green. We bring in 13,000 profit. Now we're running 10,000 ahead of the game. And we only put 21,000 into. Why? Well, because one of the stocks, it just didn't pencil to work. It wasn't good. So we only traded 6 out of 7. So we only put 21.8 in. The next week, it only took 25.8 just because of the option pricing to take the positions we wanted, but it brought in 23,000. So the grand total is now 33. Now this is profits. This isn't the total accounts. This is the profits. Week 6, 3,800 net to the upside. Not very much, but we didn't lose any money. So it goes up to 37.17, and it took 26.9 to get into this. The next week, options are a little more expensive, and it takes 32,000 to get into the trade. You can see that 32,686, 32,365. And then you've got 37,000 is the running total, because we made a grand total of $232 that month, or that week. Yay! For our $232. The next week, you drop 4,000. The next week, you pick up 1,100. And the final week, you lose 9. That was a brutal 10 weeks. But how brutal was it? Let's take a look. At the end of 10 weeks, you're still 25,000 ahead. On a $50,000 account, that's a 50% profit over this lousy 10 weeks. 25,707 was the gain. Average took 28,000 every week to make that happen. Average 11% per week growth in a lousy 10-week period. And you can see we had a spiky 1, 2, 3, 4 weeks, and that's where we made the money. And for the rest of that was just trading dollars. The whole point is these are volatile, unpredictable stocks. If you have the right timing, if you can see the opportunity, you jump on it, and then you sit back and let it do its thing. And the more volatile, the more crazy. It looked like it was going to go up and it dropped. It looked like it was going to go down. It spiked up. I don't care what it does. That's awesome. Just do something. Just move. Okay. So Todd says it looks like a highly profitable strategy. It is a highly profitable strategy that is highly risky. I mean, everything has risk. This has, if you put that $28,000 to work, or $2,000 to work, Tom, when you put it to work, you could lose that whole thing that week. So why would you do it? You're doing it because there is some kind of a history that gives you a reason to think that the odds are in your favor if you can ride this thing out a little ways. And that's the whole point. You have to ride it out. Question, do you strangle Bitcoin? I have no idea how to trade Bitcoin. So answer would be absolutely not. All right, now, I want to share something with you because I want you to see, kind of reality, not reality, but I just want to back up that I don't like to deal with hypotheticals. That everything I'm showing you is legit. Let me grab this and drag. So if I drag something onto the screen, tell me if you can see this, please. I just dragged a live chart onto the screen. That's almost live in a couple of minutes. You can see it? Okay, great. So I want to show you something. 11 weeks ago, the option pricing structure on Apple, if you went out of the money the right distance for the calls and the puts, you had to break even, had about $3.84 to break even, $6 to get a double, $8.08 to get a triple. That's on the call side. On the downside is pretty much the same. $4 to break even, $6.50 to double, and $8.60 to triple. Everybody see that? Give me a yes if you can see that. You see where I'm at. I'm looking at this 11 weeks ago. Now look at this is an hour and a half ago. Okay. Within the last hour, actually, this is the pricing for Apple. It was trading at 131 and 1 penny. The 133, 129 combo, to break even to the upside, you got to go $4. The downside, 402. The upside to double, $6. $8 to triple. $6, $8 to triple. 11 weeks later, the options are still about the same. Guys, on these highly volatile stocks, except at earnings, they're going to tend to behave pretty similar. Once you have an expectation of what it takes to make the right combination on that stock, you know what to look for. And you take notes on each one of these so that you know what to look for. So I'm just showing you that it hasn't changed very much. Hasn't changed very much at all. So this morning, these are the positions that I put on for Apple. And let's see, I'm going to grab this to show you. I got to be able to grab this without clicking a button. There we go. Okay, so you see the trade opened up in here for Apple. 10 contracts at the 133 calls, 10 contracts at the 129 puts. 107 is what the calls cost, 83 for the puts. When I put the order in, it was only 99 for the calls, but it missed it because I accidentally had a limit in there instead of just taking a market. And so by the time I saw it, why isn't that filling? It had already gone from 99 up to 107, so I just hit the market and jumped it in there. So it should be a little better. It should be 99 and 83, which means just under $2. Today, it's what? It's $1.90. So $1.90 is the total that goes in to taking the trade on Apple for the next 6 days. Now, based on that, Apple has got to move $4 to break even. It's got to drop down to 126.92 for me to break even. It has got to go up to 135.09 to break even. The blue is the two strike prices. If it goes up to 136, we double. What's the possibility of going up to 136? Hello, read your chart, folks. Your eyes should be going boom, boom, boom. I see it, Ryan. Where is it? Look at it. Look at this. Back here, the week of February 21st-ish, towards the end of February, we had a major stall. We had hit a huge high, pulled back, tried to rally, and it failed. So this is a head and shoulders type of a pattern. That's a big deal. Spent several days there, finally gave up, and it took a crash down to 116. That's a big deal, guys. 137-ish is a big deal. So what are the odds that we could get up to 137? They're pretty good. But what if it runs out of gas here? Support is back down in this range about 120. Well, guys, if it gets down to 124, we double. If it drops down to 122, we triple. If it drops down to 119, 120, it'll be between 400 to 500% on the put side. So I don't care which way it goes. Now, in about 3 weeks, when we get close to earnings, these option prices will skew and it may not be worth playing. And if it isn't, we won't do it. But you look at the at the money premium, which is about 225 for at the money. I can take the correct out of the money positions for $1.90. I like this. I want to be able to spend less money on my two positions than what the at the money premium is. And that's a big deal. It has to do with the size positioning and which strike prices. And again, guys, there's a lot of things to teach you on this, but the principle that I'm trying to get through today is why in the world would you consider trading a stock that is highly volatile, very dangerous, with a strangle where you have a good chance of not making money? It's because, guys, because they are volatile stocks, all of these ones that I trade, because they're highly volatile, it's very difficult for the market makers to do their magic and properly price the options to reflect that volatility in such a short period of time. They have to find a place, if they're going to do it, they don't have to, but if they're going to trade, they have to find a place where people will actually buy and sell. And so that price has got to come down to a range where it's affordable or people won't do it. The problem is that the stock can routinely overrun that model assumption. And if you get in on it on Friday, you've got 6 days for it to take that one crazy day. And with these volatile stocks, to have a crazy day or two in a 1 week period is pretty common. And then the whole model blows up in your favor. Okay? It already blows up, but it blows up the model in your favor. That makes sense, guys? Again, this is the picture that I showed you earlier. Here's where I went back and analyzed 11 weeks. And now we're going into week 12. And the good thing is that the option pricing has been steady over the last 12 weeks. So I know what my numbers are for Apple. I know what they are. If they change, I'll know, whoops, we're drifting out of the range that works. And you've got to have that for each one of the stocks. This is not easy. I mean, it is once you understand the principles and you have this done, but there's a lot of moving parts to get this set up. There has to be. So this is not and should not, and I'm not contending that this be your major strategy, but could it be one piece? And the answer is, yeah, I think it could. Don't you? It could be one piece of the puzzle. Now, let's talk about this. Account size, it's a dedicated risk account. So you've got to know your drawdown potential, and you've got to have how many days how many weeks rather, could it possibly go in a row being flat or negative? based on the average of the, what it's been doing over the last 12 weeks minimum, the last quarter. You have to assume the worst. What are the patterns that it runs? What's the worst case run? How often does it do that worst case? How long does it take to make up after it does that? You got to know something about these stocks, guys. These volatile stocks are dangerous, and the options have to carefully and accurately reflect that. And when they do it accurately, there's no room for you. You don't have an edge. You have very, very tiny edge if you wanted to put on a condor or a strangle with other legs of protection so that it can lock in a profit. It's going to be a teeny tiny profit. But here, we can throw caution to the wind, say, let it rip. Do whatever you want to do. Big to the upside, big to the downside. I don't care. Just do something big. Because you've got them in a stranglehold. You can make some success out of the pandemonium. How do you choose strike price? Now here I'm going to go really fast. I'm going to show you some of the things that I would teach you in a more extended class. The power of 50-50. Guys, 50-50 odds are great. I do not need or want 80% odds. You can make a ton of money with 50% odds, 50-50 odds, if you understand risk ratios properly. At the money. At the money is going to have a 50 delta. You are going to look for the opportunity to ride an expanding, accelerating delta. If you can find it, that's what you're going to grab. Out of the money. Out of the money is the foothills. This is the mountain. We want to take our position down here in the foothills so that if there's a big move, it escalates, it shoots us up the mountain. Or in the case of the puts, it shoots us down the mountain. Either one's very profitable. But you start out here on the foothills that are calm. They're cheap. They're boring. Okay? All right. Time value. Because you're out of the money, you have 100% risk. Gamma. You have to understand gamma. You have to, because that's where you see your opportunity. Delta is one picture, one piece. The gamma makes it come into focus. And the last thing, you cannot force the trade, guys. If it's not there, if it doesn't meet your criteria, you don't touch it. You can't force it, and you can't get bored waiting. It comes to you or you don't trade. When you open the trade, do you open them at the same time, calls and puts at the same time? Yes, at least at the beginning. I would do it almost all the time. Can you stagger and say, well, I see it moving right now. I'm going to go ahead. It's moving to the upside. I'm going to grab the put, and then I'm going to wait, and I'll put the call on later because I could, or vice versa. I could make money because it'll be cheaper if I do it then. Fair. But that's advanced stuff. Okay. Better to put them both on at the same time. How busy do you want to be? Guys, I like this as a set it and forget it strategy. Set it and forget it. Okay. If you want to monitor these and try to tweak them, you can. I just don't think it's worth it. The idea is you can set these on Friday, unless an alert or alarm goes off, you don't check it till the next Friday. Close out your position, see how much money you made, and open the new ones. Usually you do that on Thursday, by the way. Thursday night, you're going to look and see how the week has gone. If you haven't heard from it already, you're going to pick your targets for the next week based on the Thursday option prices. You're going to see how it's going to close out in the morning based on opening prices. You'll see what happens. And then you may wait and not close your positions until later in the day. If it's running in your favor on Friday and making you money, let it run. But sometime on Friday, they're going to expire. And you can let them expire if they're running in your favor. But at some point, you're going to close them out on Friday. So there is some work to do, probably Thursday night, to get ready. But you're going to do your work on Fridays. You're going to open positions and close them on Fridays. Set up contingency orders, set up alerts, and away you go. When do you close positions? I told you, you're going to close them on Friday unless something happens. Okay? You can choose to do this anytime you want, but how busy, again, do you want to be? If you're honest and consistent, if you'll follow your strategy instead of trying to switch horses in the middle of the stream, you'll find, like Warren Buffett says, it all works in your favor if you don't mess with a system that's a good system. You get in there and tweak with it, and you usually blow yourself up. I love the idea when you come to the road, fork in the road, take it. That simply means you have contingencies. So when you close positions, you've got an if-then scenario. If this happens, I close it here. If that happens, I close it there. Boom, end of story. And the last thing, When do you take profits? Guys, when you look at this, you may look at it and then your eyes get big and you go, oh, you can make a lot of money on this. Guys, I was not rolling anything back. By the way, this was simply taking a box of money and taking a percentage of that and putting the same amount in every week. Not saying, oh, we made 10,000, so let's make the trades bigger next week. Can you multiply? Yes, you can, but it also gets out of control real fast. I'm showing it to you as if you never did more than use the same money every week. And the question is, when do you take your profits out? Well, because we're not rolling it and keeping track of how big the account is coming, you can take it out every week if you want. I don't care. If it makes 10,000 and you take 10,000, is your trading position weakened for next week? No, because that 10,000 you made has no bearing on how much you're going to put in next week, at least the way I'm showing it to you. You could do whatever you want, but I'm showing you that you can literally cash flow this, take the money out if you wanted, because the money you make each week does not have an impact on what you're going to put in next week or your ability to put money in next week. Now, could you say, well, once I've built up some money that equals my kitty, you know, if you're putting 7,000 to trade 2,500, or you're putting 50,000 to trade 32,000 or 30,000, as soon as you make the profits, could you pull that off? Yeah, as long as you maintain that 50,000 for the 30,000 exposure, you could pull all the profits out because you haven't changed your machine. You haven't changed your operation. All right, guys, that's basically what I wanted to cover today. I actually hit every slide and every point I wanted to cover. I hope you can see that there's a lot more to it. And when you have an opportunity to take more training on this, if you're interested, there's a lot more. But I just wanted to show you that one example. Apple is still my favorite stock to show. It's not the most profitable, but it's the favorite one to show because it trades, and the people who trade it very consistently. It's extremely consistent and efficient. So it's a good example. Okay, that's it. It's just a good example. All right, so let's see. Let me read last couple of comments. The only thing I don't get from SDF, which interesting. Don't know what your name is, but if you haven't traded options before, this should have gone over your head. But it says, the only thing I don't get is if you buy and sell something and it moves, what is paying you? Well, there again, you have to have a thorough understanding of options in order for that to make any sense. And this is not the class to teach you the basics of options. I apologize, but you have to understand options to understand how that volatility or how that leverage factor works. Tom says, definitely a lot more to it. I like it. Yeah, me too. But Henry, will you be doing extended training for this? Yes. Stay tuned. We will. Amos, how do we get more exposure? Stay tuned. It'll be announced shortly. We're working on some tools and some actual class times. But again, the point I wanted to make, guys, is that option trading is volatile, or excuse me, is dangerous by virtue of the fact that it is extremely well done. In other words, option risk factoring is extremely accurate. They're extremely good at this. And the job of it is for them to manage risk and to take that opportunity away from you. Okay, it's not easy. It's supposed to not be easy. But, and it gets worse with volatile stocks. But the more volatile, the more profit potential. So again, I have simply figured out how to play with the big, nasty, dangerous, lethal snakes and have minimum exposure and be able to capitalize on the good stuff. That's what this type of strangling can actually work. Most strangling, no, it doesn't. It's too tightly priced, and when you hedge properly, you've given up all your profit. Tom says, sounds like good strategy for a small account. It can be, as long as it's only part of a small account. Please don't say, well, I've got a small account, I'm going to do this strategy. No, I did not say that in any, I say, no, don't do that. Okay. Chris, I agree, buddy. I look forward to talking with you more about it in a class soon. Kyle, do you trade and set up the contingency orders on Thinkorswim? Yes. But you can do it on any platform that has contingency orders. You can do that. But you do need to have the contingency set up. Why? You just don't want to be interrupted in the middle of the week, totally unannounced with, you need to go do some calculations and make a value judgment on what you should do here and what you should do there. Well, what if you're busy? You know, those decisions should already be made. Set up with contingency so you don't have to. You're likely to screw it up and change your decision anyway, if that happens to you. So, all right, guys, thanks for all the comments. Thanks for the attention, sticking with it. I hope that you got something out of this. Again, there's our little disclaimer, but there's your Coach's Corner. I hope you guys have a great weekend. Thanks, Tom. Appreciate it. Trader Will, good to see you, buddy. Robert Cole, I'm glad I'm back too, man. Good to see you. Robert Stewart, I like the market works for me instead of me working for the market. Yeah, and what you want it to do is you just want it to be crazy. You know, pick the crazy stocks, and if the prices don't work, don't touch them. But every once in a while, you'll find the crazy stocks. Then the price is right. You jump on it and you say, just do something. Be crazy, scary. Go up when the people thought you were going to go down. Kill all the put by or all of the put traders by spiking to the upside. I don't care. Do your damage. And you literally are in a position where it benefits you the worse it gets for somebody else. Hey, Chip, man, sure good to see you, man. Let's see. Is this your bread and butter in this environment? It is one of them. I believe in being diversified. One of my favorite things is an incredibly boring strategy. But if you are near retirement, boring suddenly gets not too bad if it's consistent. And on a relative basis, if it makes a whole lot more money than anything else I can think of and it's boring, yeah, I'm kind of excited about that. A few years ago, I wouldn't even look at it. I missed a lot of stuff by being young and stupid and chasing butterflies, right? Chasing money. Squirrel, squirrel. All the exciting stuff. Guys, for me to go away from a single-sided trade and to go into a strangle was like admitting defeat. Can't you figure out, you're a great chartist, Ryan. Can't you figure out which way the odds are that it'll go? Yeah, I can. But I mean, you get your head handed to you for no particular reason. You never know, no matter what you think you don't know what the stock's going to do. You don't. So when I discovered, hey, I can play with the big boys and I can take the risk into a very manageable situation and still, guys, over 10 weeks, a 50% gain on the total account, that's not bad when it was a really bad week or a bad 10 weeks. That was Apple, right? Real boring 10 weeks. Anyway, take care, guys. God bless. Have a great weekend.